Welcome to the Interproperties Podcast, where we discuss real estate and more.
Hello, everyone, and welcome to our podcast. My name is Konstantin Shelegeda, and I am your host today. Today, we will be talking about one of the most trickiest parts of getting a home. It is a mortgage, getting the mortgage. We pulled together the most asked questions about mortgages, about getting pre-qualified, about getting pre-approved. And today with me is a very experienced mortgage broker and loan officer, Declan Hartnett. Declan, welcome.
Thank you.
And tell us a little bit about yourself.
Yeah, well, thank you for having me. I've been in the industry about 7 years now. So I'm a mortgage banker. I work for United Home Loans. I also run our city branch in Chicago here in the city. So I help our clients that are purchasing residential real estate. We deliver custom tailored mortgage solutions to them, as well as helping them, refinance those properties after the fact, whether they want to look to acquire more property, become an investment portfolio holder. But FHA, conventional, VA, jumbo loans, we do it all. First-time home buyers, we love working with. So, yeah, that's the gist. Long-winded.
All right. So if someone is currently looking for a home, first-time buyer or not a first-time buyer, investor, they should. That's probably the episode. This episode is for them, right?
Yes, 100%. Yes.
All right. So what we do here, what we'll be doing today, is I will be pulling out those questions, which we already have pre-written, and I'm going to ask those questions. Please,
Hopefully, I know the answer. All right.
Yes.
Let's fire away. All right.
Let's start it. Is it better to buy now or wait for rates to drop?
All right. Tricky one right off the bat. All right. So let's talk interest rates first, because everybody always wants to time everything perfectly, right? Just like the stock market, want to buy everything at the perfect time. If we look at historical data, they've been tracking mortgage rates now for about 30 years. Okay. If we look at just the last 30-year window, they've been tracking it before that. But if we just look at the last 30 years, the average over that period of time is about 7.77%. Today, your average 30-year fixed loan somewhere in around probably 6.99 to 6.5% on a good day. So right now we're already sitting slightly below the average. However, most people are, we're coming out of this crazy low period we had where rates were 2-3%. Everybody's asking, when is that coming back? Well, one, I don't know if it is, but two, I think it's more important almost for us, everything boils down to the client is your monthly payment. So timing the market is near impossible. But I think what is attainable is purchasing real estate that you can't afford, that you are able to make that monthly payment come hell or high water, no matter what. And as long as you don't have to sell that property at a point in time when someone like yourself is telling you, do not sell that property, you can't lose in real estate, in my mind. And if you look at that, you look at the data behind that, it'll support that. So in my mind, it's corny, but you're marrying the home and you're dating the interest rate. So what I can tell clients is in the next 5 to 10 years, whatever your payment is today at that 6.99%, every time we have an opportunity to refinance, we're going to do nothing but drive that monthly payment lower. And, I think that eases people sometimes. And then, within 5-10 years, you might be seeing that same type of equity growth that we just saw.
Right. And I think that it's very important if you're a first-time buyer to get your foot in the door.
Yeah.
Buy it and see how it goes for you. And most likely you will be happy with your purchase, with your investment, and with your home if you reside in there.
100%. And I think values right now, I don't predict that they're coming down anytime soon. I think we have an inventory issue, at least here locally.
Absolutely.
So to me, the barrier to entry is only going to get harder and harder for those that haven't taken that step and become that first-time home buyer. So yeah, I'm right there with you.
Absolutely. You're
Yep.
sitting, you're waiting, and the property value is growing. So
Correct.
you're losing right there.
Yep, your down payment has to get bigger. It takes longer to save that up. And on top of it, as that's going on, typically your rent is following the same suit, right? So you're shelling out
Absolutely.
more currently in rent, and it gets tougher and tougher.
Yeah, I agree with you 150%. Let's go to the next question.
All right.
This one is,
Yeah.
what if I get pre-approved and then I find out I cannot afford my monthly payment? How is that?
Okay, so for one, I would say you have a bad mortgage banker. So I won't name companies by name, but there are these giant multi-billion-dollar corporations where you can go online, give the computer application, what the info that it's asking you, whether you're giving it rough estimates and so on. It can pull your credit report for you, and it can generate a generic pre-approval letter. When someone like yourself is selling a property here locally, typically you don't want to see a generic, giant online mortgage company's pre-approval letter that doesn't have a specific banker, whose cell phone or office number you can get a hold of and contact to verify, the letter that you have. So to me, I think it has nearly next to nothing. What was your question again? I just lost my train of thought. Hopefully we can edit this.
Yes, the question. Yeah, you were going very well.
Yeah.
So the question was, if I get pre-approved, I purchase the property, and then I find out that it's hard for me to afford to pay monthly payment.
Yeah, to me, it's just signaling that you didn't go through the pre-qualification process the right way. So with our clients, it's not just checking a credit report and then sending out a letter. It's verifying, reviewing our clients' liabilities, their credit report in detail. Also, going through their assets, going through, income, viewing everything from, a 30,000-foot view. And from there, it's almost reverse engineering the math. To me, what your situation you're asking about is screaming, they were pre-approved up to their absolute maximum budget. And I would make the argument that most people today can qualify for a bigger mortgage, a larger total mortgage amount, and i.e. a larger monthly payment than they will ever be willing to pay. So to me, it's less about how much am I total qualified for in total, and more about where do you want your monthly payment to be with everything included, taxes, insurance, association, all of it. Where do you want that number to be? And from there, let's go backwards. And, as long as that number is under what you're qualified for, you're good to go. So to me, it's focusing on more so that monthly payment and the individual client's monthly budget.
Right. So hypothetical situation. I purchased the property. I love it. I live in it. And half a year later, I lose my job or my wage goes down and I'm struggling.
Yes.
What do you think? It is hypothetical, of course. What do you think would be a good step for me to see what I can do to stay afloat?
Yeah. For starters, calling the mortgage bank that you're currently paying that's servicing that loan. So the servicing side of the industry is you making that monthly payment. The bank that's on the back end collecting that monthly payment every month, reaching out and contacting them is the best thing you can do up front. And I think people tend to hide from this. They don't want to admit that to the bank. They're worried, there's going to be some sort of negative fallout even quicker because of that
the stigma of it.
Yeah, right? Or even people, just telling them, are they going to come?
Comfortable to talk about it.
Right. Or do they want to come get it right away? Is this going to make my situation worse? So I totally understand that. I think, but for starters, reaching out, something dramatic like that, losing a job, a death in the family, something like that can... it's common that these servicing banks, they can be understanding about that. And a lot of times in the short term, you could stall and get some sort of forbearance on it. So sort of being able to delay those monthly mortgage payments, maybe rolling them into the back end instead of taking the penalty up front and working out some sort of agreement with the bank. But to me, being transparent with them and then also calling your mortgage banker if there's some way that you can utilize a refinance or something to save yourself money and put yourself in a better position. That to me, that's the second person I'm calling. But being proactive and dealing with it is just much better than sitting on it and, panicking, in my opinion.
Bottom line, there are ways to
deal with it, though. Yes, you're not stuck. Yeah.
Be proactive.
Yeah.
Very well. Thank you, Declan.
Yeah, no problem.
Next
All right.
one. Do I really need 20% down to buy a property?
No. And I can't tell you how many people ask me this question. Absolutely not. So obviously what comes with the 20% down payment is a lower monthly payment. So if you have 20% down and you don't feel like, you're shelling every penny that you have saved up in order to acquire a property to get to 20%, if you have it, do it, great. You'll get likely maybe even a better interest rate because of it. No monthly mortgage insurance attached to it. So it's a better deal all around. It makes perfect sense. If you're trying to get into a property for the first time, like a first time home buyer, I think it's very important for people to know that more than 80% of the first time home buyers, I would say, that I deal with today do not have anywhere close to 20% down. And even those that do, showing them their options at 15, 10, 5, and how much less they're going to spend at the table versus the slight difference in higher monthly payment, a lot of them end up opting to go with the lower option to begin with. Monthly mortgage insurance has this weird stigma attached to it. People think it's this crazy high fee. FHA just lowered their monthly minimum, so it's or maximum rather. So theirs is much cheaper than it's ever been.
Can you include the PMI into a mortgage, or it has to be prepaid?
There's technically two on an FHA. There's an upfront that one you can roll in, but then there is a monthly fee. However, it used to be a lot higher than it was. I want to say it was like a 85% monthly factor. Now it's down to, I believe, a 55. So they've almost cut it in half. So yes, and it's much more competitive with like a conventional PMI. It's still on the higher side, but there's a reason you're going with FHA over conventional at that point. That's beyond PMI. But with a conventional loan, if you have, especially if you have two borrowers and you have anywhere in the mid 700s or higher, yeah, I guarantee you your monthly mortgage insurance is far lower than you think. Probably, we're talking in the $70 to $120 range a month tops. So, it's less consequential than people think, especially versus how long it might take somebody to be able to get to that 20% point to even get in, right? As we were talking, how far has the barrier of entry moved by that point, right?
Got it.
So no, and to answer your point specifically, a conventional loan will let you go to, as a first-time home buyer, as low as 3% down.
Wow.
And FHA will allow you to go as low as 3.5%. And then VA is the best. They will allow up to 0% down. It's the best benefit, in my opinion, that you get in the military once you're out.
Awesome. But you go and buy it. That's it. You go and buy it.
You got to get in. Yep.
Yes. All right. Next one. How do I know how much house I can afford? And what do I do if I get approved for more than I want?
Yeah. Again, I think it's speaking back to one, work with a mortgage banker that has your best interest at heart and has some sort of process that's walking you through this. But very early on in the conversation between myself and the client, we are talking about what their monthly budget is. And just because you are qualified for a $700,000 house doesn't mean you should go buy one, because if you don't want your payment to be above X, that might, and if it's not possible on this specific property at that number, that's your answer up front, in my opinion. So I think it's working with a banker that at least is working with you to nail down your monthly budget, and then giving you the price range that you should be looking at in order to achieve that monthly budget.
Right. Think also about unpredictable things, what can happen in life, and why to stress yourself out and go to a maximum if you can stay at the comfort
100%
of payment.
To your point that you were just asking.
I usually tell my clients the very same thing. Don't stress it out. Don't stretch it out to the stress point.
Yep. I like a married couple. I often will say, if one of you were to lose your job for a 6 to 12 month period, are you worried about making this current monthly mortgage payment in that time? If the answer is no, in my opinion, the risk is substantially less than they have probably built it up to be in their head.
Yep. 100% agree.
All right. We're cruising.
Can I buy a home if I have a student loan and other debts?
Yes, absolutely. Student loan monthly, as far as how I am looking at your credit report and your monthly liabilities. So all of those loans, student loans, car payments, credit card loans, all we are looking at is the monthly minimum payment, and that's what is factoring into your debt to income ratio. So for a lot of student loans, the monthly payments are not huge on those. So they're not usually as impactful despite, the total sum that might be there. The monthly hit that you have to overcome on paper might not be as big as most people, I feel like, build up in their head. But you absolutely can. There's also constantly, they're ever changing, but all of these sort of government incentive programs that are starting to roll out that will actually attach student debt in particular to the acquiring of property for first-time home buyers. Illinois just had a plan earlier this year. The money has already run up, but to me, these things are never ending. They'll come up with some new form of it and allocate a portion of money, and it'll run for a few months like the last one. But that product, for example, would pay off your student loans up to a pretty significant level. I want to say it was like even maybe $50K total, but it was a large chunk of change as long as you were acquiring a first-time home buyer acquiring a residential real estate in the state of Illinois.
About the debt and income ratio, can you identify what is the difference between FHA requirements and conventional?
Yes, it's pretty slight. So general rule of thumb, conventional will allow you to go up to a maximum of 50% debt to income ratio. FHA will actually allow you to go higher. If you tried to run through automated findings, is the software that's used for conventional and FHA, Fannie Mae, and Freddie Mac. Each of them have their own software for all of it. When you run a file through that, if you tried to run a conventional loan at a 51% debt to income ratio, it's a hard stop. It wouldn't work. But an FHA, however, can go a little bit higher. So if on paper there can be all sorts of reasons. A lot of times it's a married couple, maybe one of them has gone through some financial hardship in the past and their credit score is significantly lower than their spouse's. We'll put one, and one of them can qualify for the mortgage by themselves, but it might push the debt to income ratio pretty high, maybe even over 50%. That to me would be a great reason as to why you would be choosing to go with an FHA mortgage over a conventional, solely because the FHA will allow you to go higher on the debt to income ratio. Most people would think like 55%, but it's kind of by a case-by-case basis.
50% is kind of what you have to
correct
look at as a limit. Correct.
Like to me,
yes.
to me already, if you're at a 45, 46, 47, 48, 49, 50, anywhere near there, to me, it's exactly what I'm describing you. There's some other circumstance going on, like maybe there's more income coming into the house than we're showing on paper because we have to leave off the mortgage in order to get a better interest rate or something like that. Like that would be the only reason in my mind that you're doing that, because otherwise, yes, you're definitely stretching your budget.
All right.
At that point.
Got it. Okay, next question.
So long-winded answers. Yeah.
Good answers. What are all these hidden costs? Remember hidden costs? We always hear about those.
Yes.
What are them?
Okay. So my boss, Mike Duo, always says this. He's the president of our company. I think, it's a good line. But the mortgage bank that is showing you the lowest cash to close and the lowest interest rate are usually not mutually exclusive, because if you want to pay, if you're going to have the absolute lowest interest rate than you're hearing from anybody else that you're getting quotes from, most likely they are also at the same time not able to deliver you the lowest cash to close. It doesn't make sense.
So
right?
What are those?
So that's exactly
Prepaids?
getting to those. Yes. So no, prepaids are going to be there. Title fees, escrow collection, which falls into prepaids, interest throughout the rest of the day. Those closing costs are going to be there no matter what, whether you go with mortgage banker A or mortgage broker B, right? Same thing both ways. The seller actually picks the title company in Illinois, right? And the title company is the one that's going to tell you how much money they're charging you. So Those fees are there no matter what. Box A on the loan estimate or the closing disclosure is usually your best bet of where you find these quote unquote junk fees. So the most common one that I see is what are called discount points. So you can pay a lump sum cash at the closing table. So a larger closing cost fee line item that doesn't need to be there. You can pay that in order to buy your interest rate lower in perpetuity. Now, does it make sense in some situations in order to achieve a client's budget that might be cash heavy, but worried about monthly cash flow down the road? Maybe they're retiring, whatever it is. In that situation, spending money on discount points might make total sense. We've also gone through a crazy, turbulent mortgage rate market the last 2-3 years. So there have been these pockets of 4, 5, 6 months where rates spike and have sat as high as even like 8%. When you see those kind of windows, it totally, in my mind, makes sense to maybe pay one discount point might be it. But it's all about the client and having that conversation. I think where I see a lot of like the big online lenders take advantage of people is they're sucking you in with the billboard that says the 30-year interest rate at 4.99%. I'm on the other end of the phone telling you mortgage rates today are 6.99%, right? They're like, what the heck is this guy talking about? I'm going with the company that's advertising. But in the tiny little writing at the bottom of the billboard when you're driving 70 miles an hour that you can never read, they're explaining that you're paying $7,000 in discount points additional at the closing table in order to buy that interest rate that low. To me, it's very important to have the conversation with the client of showing them the difference between going that route and here's where you save $7,000 at the closing table, pay a slightly higher monthly payment, and how do you feel where interest rates are going in the short term? Because in my mind, we're in a declining interest rate market. As rates come down, you can get those refinances for free.
Right.
And then, in 6 months to a year, if you've shelled out $5,000 to buy your interest rate lower, but now the market's lower than that, you're going to have actually been lost money in the long run.
Yeah, it comes to the point where you should speak to a professional, you should consult, you should ask questions about those hidden fees and calculate and see who's who and what's offered out there. But talk to your professional.
100%. Transparency is key. I feel like we're big on that with our clients, and I think that's where we can add the most value, especially in this industry. So couldn't agree more.
Awesome.
All right.
Next one.
All right.
And next one. How do I avoid PMI, or is it even a bad thing?
There you go. There you go. So most people would think the only way to avoid it would be to put 20% down. That's not the case. So there is a way. It's called you have two options actually when it comes to PMI. So if you're putting less than 20% down, you can either take the monthly PMI, where that's going to be on there as a part of your monthly payment. On a conventional loan, it's eventually going to fall off once you hit that equity point of 22% is when it'll automatically fall off. You can do that quicker with a refinance, obviously, especially if the market has gone up like it has. Shoot, I lost my train of thought again. What was it? How to avoid it?
Yes.
The other option would be an upfront premium. So you can pay again, similar to almost like a discount point. You pay a lump sum, one-time fee at the closing table to buy the PMI outright for perpetuity of that loan. However, I think it's a little bit dicey because that gets pretty expensive when you're putting only, let's say, 5% down. It's pretty cheap at 15% down because you're pretty close to that 20% equity point. But if you're at 5% down, it's pretty expensive. And on top of it, the fear would be if you have an opportunity to refinance within a year or two and your equity, you're not at that 20% point yet. Mm-hmm. PMI is now we have to deal with again on that refinance mortgage.
Oh, I see.
So they can almost be double dipping you depending on, what the market has offered you. So to me, it again, knowing your options, going through, having a banker walk you through both and seeing those, I think for most people when they see what their PMI is on the monthly factor, it's pretty low compared to, shelling out a couple thousand
All
extra.
right. Yeah. So talk to a professional.
Possible though.
Yeah.
Yes.
Talk to a professional.
Doable. Yep.
Get the numbers.
Yes.
Next question. I'm a self-employed.
Okay.
Am I screwed up?
No, you can get a mortgage.
Fine.
You can absolutely get a mortgage. I will say, I think why these horror stories are out there, the way Fannie Mae and Freddie Mac, who are the two backings behind conventional loans, the way the guidelines are put together for a self-employed borrower, it definitely makes it more difficult to qualify for them than it does for, let's say, a W-2 salaried employee. Just off of the basics of a W-2 salaried employee, I am allowed to use their guaranteed base salary. Whatever the employer is telling me is their guaranteed base salary. If they tell me it's $120,000 a year, that's obviously the pre-tax number, right? The client's not clearing that a year, but I get to use all of that as qualifiable income to qualify them. I get $10,000 a month of qualifiable income out of that. With a self-employed borrower, I have to derive their qualifiable income based off of their tax returns. And obviously, their tax returns are going to be essentially a lot closer to their true take home, as well as we all know a good CPA is probably going to be slightly aggressive in some areas. Right. And that's actually working against that client when trying to get qualified for a mortgage. However, because of that, there is a space in the non-qualified mortgage space. So we have all kinds of brokers that we work with that offer products that are basically tailored directly to these types of self-employed situations where they aren't able to get enough qualifiable income on a conventional loan, but they will offer a product like, for example, a business bank statement loan, where instead of using the traditional income documents to qualify them from an income standpoint, they're going to use 12 months of business bank statements, the deposits, and an account balance holding over the time versus the withdrawals. And they're going to come up with a monthly qualifiable number based off that. Those numbers can be significantly higher than what that same client might be getting from a conventional side. So I've had a lot of clients go that route, and there are definitely, So the short answer, yes.
Yes.
There are a lot of ways. No, you are not screwed.
Yeah.
Yes.
Talk to a professional.
All right.
That's what I continue saying.
Yep. Everyone. Yeah.
Yeah. Next question. What's a rate buy down, and should I do one?
Yes.
And we spoke about that slightly already.
Yes.
Yeah.
So there's like two avenues right now. The discount points that we talked about, where you can pay a fee to buy your interest rate down lower. The second one is a 2-1 buy down that you might hear right now. That's more of a way to utilize a seller credit. So let's imagine a property that's been sitting on the market for a little while. Maybe it's priced slightly too high. And instead of a client offering maybe they offer $5,000 higher than they were willing to, or they think the property, either they were willing to offer on the property, but with that offer, they get all $5,000 back as a seller credit. Utilizing that seller credit would be a 2-1 buy down is a way you could structure it. You're going to need more than that $5,000 for most people, but there is a way. And in that scenario, for the buyer, the seller credit is basically used to supplement the mortgage payment. So for year one, your buyer feels like his mortgage payment is 2% lower than what his actual interest rate is. Year two, it looks like it's 1% lower. So it can significantly cut down the monthly payment in the interim.
From the very beginning, or there are buy downs which are buying down your interest rate all the way till the end?
Yes. So like both ways. The 2-1 buy down with the seller credit, I guess if you're going to do the 2-1 buy down, I'm using the seller credit to give myself this bigger monthly difference benefit for a shorter window in year 1 and 2. So sort of ease the maybe payment shock. So it's great for a first-time home buyer, right? The other way would be we're going to use the seller credits to buy our interest rate down into perpetuity. You would see probably a smaller monthly difference on that situation, but obviously it's going to be for a longer period of time than 2 years.
All right. What's one mistake buyers make
after getting pre-approved?
After getting pre-approved? Right.
Yes. I would say that's easy. No new credit. So I'm pre-approved. They get the pre-approval letter from the mortgage banker. They talk to the real estate agent. They put an offer in. You get them under contract. And 2 weeks before the closing, they go and they buy a new car. And now, before the loan closes, the mortgage bank is obviously going to do a soft credit pull to make sure that no new debt has been obtained. That new debt is found. They have to apply that new car payment to the client. And now the client doesn't qualify. We've blown the whole deal up because they went and bought the new car. And all they had to do was wait until after the closing. So we're always, one of the first things we always tell all of our clients after they're pre-approved, no new debt until after the closing.
What about going and depositing large cash amount
that's
into
probably,
your account right before the closing?
That's coming right after that. Yep, number two, no large cash deposits, definitely. Yes, you want to ideally avoid that at all costs, especially if you want to use that money. Is that the be-all, end-all? No. If you, you get a buddy of you owed you money and you put he owed you $1,000 and you deposited that and totally forgot. And now you're like, oh my gosh, am I going to blow up my mortgage transaction? No, we can just deduct it out of what your assets are showing.
But the question will be asked.
But if you need it, now that's a problem. So yes, avoid that at all costs and call your mortgage banker to walk you through how you can structure that to get through that smoothly.
Yes. Talk to a professional.
Yeah.
Next question. My credit score is below 700. Does that mean that I cannot get a mortgage?
No, definitely not. Definitely not 700. 620 would be your general rule of thumb. You would think. Below that, you can definitely go lower. It starts to, you might not be able to go lower with low down payment and no cash reserves. You'll start to hit these limits of needing something to sort of outweigh the lower credit score. 580 is as low as I've ever seen. But 620 is your general rule of thumb for minimum credit score. If you're in that 620 to 700 range, that's likely going to be the bulk. That'll likely be the reason as to why you're going to go with an FHA loan over a conventional loan. But no. So, can I get a mortgage with a credit score below 700? Absolutely. Call me. Yes.
Great. Next question. I just decided I want to buy a home. What should I do first?
Call a mortgage banker.
Call a professional.
Before they have you running all over the city trying to show them a million places, before they even understand, again, like where their monthly budget, where they need their budget to be, how they want to set up their down payment, what they want to spend at the closing table. These are all things that need to be answered, in my opinion, before you go home shopping, before you fall in love with the kitchen that you love and, the home that you want. Get your finances
ready.
Yes. Before you have your agent running around, get your finances in order. Yes.
You're a professional.
Yes. Yep.
Next question. Can I still qualify if I had bankruptcy or foreclosure in the past?
Yes, you can. There's going to be a waiting period, and that's going to be different based on which type of chapter bankruptcy that was and whether you're going conventional or FHA or VA. But in short, no, it's not the be-all, end-all. I would again say it's another reason to reach out to a mortgage banker sooner.
Absolutely.
Whenever you're starting to think about it again, and whether now is the time or not, at least get a plan in place so that you know what you can and can't do, and
start gathering information.
Get it together.
Planning ahead. Correct. Yeah.
Totally.
Yep. Is it better to pay off my debt or save for down payment?
I would say it all depends. Is your current debt, hampering your credit score? Then definitely we need to address that. Also, what type of debt is it? Is it credit card debt at 22, 25, 26%? Pay it down. Like that, you can't. No savings account, no brokerage account, no day trader is going to outperform that type of interest. So Those trade lines is bad debt. But having $20,000 of student loan debt at a federally backed decent interest rate, that's versus using that money to acquire your first property, I don't think it's necessary to pay that loan off before purchasing your first property.
Yeah. Again, talk to a mortgage banker.
Talk to a banker.
Yes. Look at your options, and then the best decision will be made judging on those
100%.
qualifications. Yeah.
Couldn't agree more. One more, last one.
More.
Here we go.
Can I use gift money to buy for my down payment?
Yes. And I do think it's very important for first-time home buyers to know that just in my own business, more than 50% of first-time home buyers that I've dealt with have at least receiving some sort of gift funds from, whether it be a parent, family member, any sort of close relative, something like that. There's sometimes some stigma with it. I think home prices as we see here locally, they're making the barrier to entry, as we discussed, incredibly tough. So it's becoming more and more common to have first-time home buyers, especially getting help from family members, parents. It doesn't even need to be necessarily a parent. It can be any sort of relative, close friend, even kind of on a conventional loan. FHA is a little more stricter. You sort of has to be a family member, but yes, short answer, yes, you can definitely get gift funds, and it does not matter the percentage of it, either whether it's FHA or it is a conventional loan. If all of the down payment and closing costs, basically the entire buyer's bottom line, can be covered by a gift.
And in terms of the form of the gift, how does it have to be structured?
Yes, the most common on a conventional loan, I always tell clients the easiest and best route, because typically the gift giver is not a part of the mortgage transaction. So they don't want to give me mortgage, rather asset statements, or they're not one of my clients. And I totally understand that. So conventional loans will allow the gift giver to wire the gift amount directly to the title company at the closing. I suggest that with every single one of my conventional clients that are receiving a gift, because that's the easiest way to get the gift through underwriting, because then the only thing we need is a letter and then a wire coming in to closing that matches that amount.
All right. Beautiful.
So easy.
Again
and
again, talk to a mortgage broker.
Yes.
Right?
Yes.
Talk to a mortgage professional and get that in place.
Yes. People have more options than they think. I think that's the biggest, the biggest take that I find.
All right, Declan, thank you very much. That is all for today. Big thanks for being with us.
Thank you.
And if we find this useful, that's for our audience. Get back to us, call us, write to us, and we will be more than happy to help. Thank you so much.